Connor, Philip, Brandon, and Jackson. Hello.
Hello. Morning. Condo.
Okay. I'm early, but you are too. Are any of you guys still in the dorm, or are you all back home?
I think they kicked everybody out.
Everybody but the students who had no place else to go. I think they're allowing some of the international students to remain.
Yeah, probably.
Believe it or not, was it your class? One of your classmates is back in Spain. Another one's back in Russia. Some of your classmates have gone home. They're still in the class. They're just not in the dorm. I need to announce this before we adjourn, after we have a full class. We're meeting Wednesday, but we're not meeting next Monday. Had this still been an on-campus class, it would have been canceled for next Monday anyway. And I've checked around, and that's what we're supposed to do. So we get a day off. Elisa.
Yes.
Where are you in Russia?
Well, I live like 3 hours away from Moscow.
Wow. You're right in the heart of it. Okay. Are they, I presume they're taking a lot of precautions there.
Yeah, it's really strict over here. Like, I cannot leave the house right now.
Is the military enforcing the shelter in place?
Yeah.
We should be. Whoa. Macy, is that your boyfriend or your husband, or?
He's my boyfriend.
And he's a pilot.
Yeah, he's getting his license.
Cool. I'm waiting another 4 minutes to noon to officially start, just so we don't start too early. By the way, have any of you listened to the voiced over PowerPoints I posted? I actually made those a couple of years ago when my voice was not great, but it was better than now. Anyway, if you haven't looked at them, that's another resource that's probably better than these Zoom recordings, but whatever. The voiced over PowerPoints are huge files. So we have to break them into several smaller files. I've heard from students, some students, that they like that anyway, breaking it into smaller pieces, but it's it's because the files are so huge that, for instance, for chapter 10, you may have 7 or 8 different voiced over PowerPoint files that make up the whole chapter. If I put it in one file, your computer would grind down trying to load the whole thing down. Well, guys, I've just about got noon, so we'll start. For beginners, we meet Wednesday, as usual, but we don't meet next Monday. Next Monday is the Monday after Easter, where we're still meeting on campus. Day classes would be canceled anyway. But I consulted with the registrar and the dean, and they both said, let's cancel the online Monday classes, the day classes. Okay. What are we about to get into? We are about to get into three chapters that all go together. Chapter 10 is called the cost of capital, or you know the symbol WAC from an earlier chapter. This shows us where we get WAC, okay? Chapter 11 is called capital budgeting. I think it's called capital budgeting basics. And then chapter 12, and I forget the title, but it's something like capital budgeting cash flows. Okay. All these chapters are part of a package. They actually show what companies do to evaluate big, expensive, long-term projects. Like that Nissan factory in, guys, I always draw a blank on the name of that town, north of Jackson. What is it?
Canton.
Canton, yeah. Nissan went through an analysis that captures these three chapters before it decided to build that factory. In fact, all three chapters work to decide whether a project proposal, like let's build a factory, whether it gets a thumbs up or thumbs down. That's really what we're after. The chapter we start with, cost of capital, looks at all of our sources of funding to pay for the factory. To figure out the minimum rate of return we need to earn on the factory to justify it. Now, by the way, capital itself is a term that refers to long-term funding. For corporations, this could be long-term debt, but the sale of bonds. For a small handful of companies, this would also include the sale of preferred stock. And then under the category of common equity, we would have retained earnings, and the sale of new shares of common stock. Long-term debt, of course, involves long-term bonds. Preferred stock has no maturity, so it's long-term. New common stock has no maturity, so it's long-term. And retained earnings belong to the shareholders, so it's considered long-term funding. By definition, capital is long-term funding, and companies follow a maturity matching concept. They fund long-term projects like the Canton factory with long-term funds. So what would not be capital? Well, really anything that's in current liabilities. Because by definition, current liabilities are short-term sources of funding. So you'll notice that word capital pops up in all three of these chapters, because we're really talking about analyzing long-term projects that will be funded with long-term funding. Okay. Enough of that. So to start, tell you what, I think I have an Arnold Schwarzenegger keyboard. I have to really hit it hard. So, cost of capital. What sources do firms, I'm going to squeeze this in, actually use? What do most companies actually use? Honestly, long-term debt and retained earnings. Most companies don't use preferred stock. there's a small handful of companies that use preferred stock, and these are regulated monopolies. I'm peeking to see if that pops up in a slide later. It doesn't. So, couple of little notes on all this. Sorry, I'm a little wonky with my procedure still. Who sells preferred stock? To raise money. Regulated monopolies. Companies like energy, Western Gas, electric companies, gas companies, they are regulated. They are the primary companies that use the preferred stock market. And I think I misspelled preferred. Oh, well. Now, here's the funny part. Who buys it? Or invests in preferred stock? Then I spelled it correctly. Other corporations. I probably mentioned this in the prior chapter right at the end. Other corporations get a huge tax break when they invest in the stock of another company. And because they get a huge tax break, they drive the yields down way below what would be good for individual investors. But my key point is most companies do not use preferred stock funding. And most companies for capital budgeting projects don't use notes payable because that's not capital, that's short-term funding. And as I said, most companies like to match the maturity of the funding with a project. If you're going to build a factory you're going to run for 20 years, you don't want to finance it with a 6-month loan. You want to finance it with long-term bonds and equity. Now, another thing, most companies don't like to sell new shares of common stock. Kind of odd, but they avoid it like the plague. If you look up any major corporation, there'll be places where you can look up how many shares were outstanding for the last 10 years. And what you're going to find is that it hasn't changed. Most companies you've heard of have not sold new common stock for this reason. Corporations. Wow. I need to go back to spelling school. Corporations prefer to not sell new common stock for the following reasons. Number one, high flotation costs. Or if you want to think of it this way, investment banker fees. When a company sells a security issue to the public, a new bond issue, a new stock issue, there's a middleman that sells it for them, called an investment banker. The riskier the security, the higher their fees. So they charge a lot higher fees to sell stock than they would to sell bonds. So one deterrent to selling new common stock is companies would prefer not to incur those high flotation costs. Another reason they don't like to sell new common stock shares has to do with control. The new shares will carry votes. So if a company is concerned with maintaining control, they don't want to sell more shares of stock with votes that could fall into other investor hands. You know, if management is trying to maintain control of the company, they don't want to issue new votes to new shareholders. But the biggest reason has to do with something called asymmetry of information. In English, what that means is management knows things about the outlook for the company that outsiders don't know. In fact, we call that inside information. Well, so what? Well, investors, I hate to use a poker analogy with the Baptist college, but in poker, there's this thing about looking for tells, looking for clues as to what the other players are thinking. The market is always looking for clues as to what management is thinking. And here is the rub with selling new shares of common stock. When would management want to sell new shares? When management thinks the shares in the market are what? Overpriced or underpriced? When do you want to sell something? When you think the market price of the item is too high or too low? Too high. Investors, if management decides they want to sell new shares of stock, investors think, hey, management would only be trying to sell these shares if they thought they were overpriced in the market. And what that does, the very act of selling shares sends a negative signal. I'm an investor. Microsoft decides to sell more shares of stock. I'm thinking Microsoft's management would only do that if they thought the share prices were too high. And of course, what message does that tell me? Well, the share prices are too high. I'll sell my shares. Sends a negative signal to the market, which causes people to sell stock, drives the price down, which of course is not what you want to happen. So, companies don't like to sell new shares of common stock. They don't like to sell preferred stock except for regulated monopolies. So what does that leave them with? Primarily long-term debt and retained earnings. Retained earnings here is not the retained earnings on the balance sheet. This basically refers to the retained portion of current earnings. A lot of people have a total misconception about how companies pay for expansions. Collectively, for major corporations, about 2/3 of the money they use for expansion, like Nissan to build that factory. If they are typical, 2/3 of their money to build that factory came from retained earnings. Companies, when they make a profit, well, today, most companies don't even pay a dividend. They hang on to all of it. Even those that pay dividends don't pay all their profit out. They hang on to a good bit of their earnings so they can fund expansion. All right, well, I beat that to death. So, if we fund a project, we're going to fund it primarily from debt and equity. Now, in this chapter, what we need to do is figure out the rate of return we need to earn on the whole package of funding to keep everybody happy. So we've got to figure out the rate we need to earn to cover the cost of debt and to earn enough on the equity portion to keep the shareholders happy. That's what we're after. We got to cover the interest payments on the debt and have enough left over. I don't know where I got that guy. So that the stockholders are satisfied. Now, what's the term for this minimum rate of return we have to earn on the whole package of funding to keep everybody happy? It's called the WACC, weighted average cost of capital. In algebraic form, it looks like this. It's the weight for debt times the required rate of return on debt, the weight for preferred, if you use that, times the required rate of return on preferred, the weight for equity times the required rate of return on common equity. These are the weights, and they're very straightforward. If we get 40% of our money from debt, then the weight for debt would be 0.4. If we get 10% of our money from preferred, the weight for preferred would be 0.1. Now, what are those other items? These are what are called, sorry about all the sideways stuff with those are called component costs. And all they are, sorry. They're the required rate of return on each source of funding. And that's the reason we call it weighted average cost of capital. We use weights. And the concept cost really refers to opportunity cost. For instance, if on the debt, we had to earn, let's say, 6%, that's the opportunity cost of debt. That's what we have to pay for funding from that source. I don't know if that's sunk in or not, but okay. And this is what I just went over. Now, the process, very straightforward. Texas two-step. First, you find the component cost of each source of funding. That is, for every source of funding you're going to use, you calculate the minimum required rate of return on that source of funding. You'll see this in a minute. If you're going to use debt funding and to cover its cost, you need to earn a 6% return, then the component cost of debt would be 6%. If you're going to use retained earnings for part of your funding, and the shareholders on the retained earnings want a 15% rate of return, then the component cost of retained earnings is 15%. So basically, you calculate the required rate of return on each source of funding. That's called a component cost. Then you take the weighted average. Voila, you're done. It's that straightforward. To see how this might work, let's assume that, and I'm skipping ahead, I've already covered some of this. Let's assume, well, first of all, we're looking at Ultra. Ultra's looking at building a new factory, trying to decide if it's a good idea or a bad idea. Ultra will, like a lot of companies, it'll only use long-term debt and retain earnings. It will not use preferred stock. It will not sell new shares of stock. So I covered this, forgive me. Okay. So first we're going to look at debt funding. Ultra has consulted with its investment bankers, and they've advised Ultra that if it wants to raise long-term debt, it should sell bonds. More specifically, They should have a 20-year maturity, have a par value of $1,000, big surprise. If they put a 10% coupon rate on the bonds, they believe the bonds will sell at par. And by the way, every time a company wants to sell a new bond issue, they try to design it where it'll sell at par. They try to make it where the maturity, the coupon rate, everything's good enough that the bonds will sell at par. And let's assume, forgive me for skipping ahead, I'm skipping to slide 16. You'll see why. Okay. Ultra can sell these new bonds, but there will be a $20 flotation fee. Think of it as an investment banker fee. Per bond. Yeah, investors are going to pay $1,000, but the company won't pocket $1,000. It'll have to pay a fee of $20 to the investment bankers. So what'll happen? Sorry. There it goes. That's where I meant to be. Ultra will have to pay $20 to the investment banker fees per bond. So from Ultra's standpoint, it'll have to pay a coupon rate of $100 a year for 20 years. When the bonds mature, it'll have to pay $1,000. And what Ultra gets right now, after the flotation fee, it nets $980 per bond. So the question is, basically, what interest rate is Ultra paying on this bond? If you went to a bank, you borrowed $980, they made you pay back $100 a year for 20 years, plus an additional $1,000 in the 20th year. What interest rate would they be charging you? 10.2%. We use the symbol R sub D for what we call the before tax cost of debt. You should think of that as the interest rate on the debt. But our federal government, for tax purposes, says that interest expense is tax deductible. So we actually have a tax savings. After our tax savings, the required rate of return on debt is 6.1. We get that by taking our before tax cost of debt and multiplying it by 1 minus the tax rate. after we consider our tax savings, we need to earn a 6.1% rate of return after taxes on debt funds. I think I gave you too short a version, but for now, this is a nice little formula to put on your memory aid. Key thing is to think about this. If your company pays more interest on debt, it pays less in taxes to the government because interest is tax deductible. And this little formula is a neat way to figure out what the after-tax cost is. Now, what I'm about to say will not be on the test, but it's for you accounting majors. This 10.2% not only captures the effects of the interest payment, but the bond discount. Interest expense, like the interest payments, is deductible each year. But if you sell bonds at a discount, you can amortize the discount over the life of the bond for tax purposes. That is, you can take a small deduction each year. What's my point? The entire before tax cost of debt is tax deductible, which is why we multiply the whole thing by 1 minus the tax rate to get our after-tax cost, our after-tax required rate of return. Try this. See if you can come up with my check figures. While you do that, I'm going to peek and see who's still here. Ooh, everybody's still here. Yay! Sometimes I get so boring, I put myself to sleep. This is a pause while I let you try this on your own. And exercising my usual lack of patience. See what we get. All right. So for the Dolby bonds, they're 10-year bonds. They carry a 7% annual coupon. $1,000 par. There is a $40 flotation fee per bond. And and Dolby's in a 30% marginal tax bracket. So what is the before tax cost of debt? From Dolby's perspective, it would have to make coupon payments of $70 a year for 10 years, plus also pay off the redemption value of $1,000 10 years from now when the bonds mature. What does Dolby get now? Well, the bonds sell to the public for $1,000, but the investment bankers pocket 40 of that. So Dolby gets $960 in funding. So if you went to a bank, you borrowed $960, you had to pay $70 a year for 10 years, plus an additional $1,000 at the end. That would be an interest rate on the debt of 7.585%. Think of that as the interest rate on the debt. And that's also what we call, again, the before tax cost of debt. It's our required rate of return on debt before we take into account the tax savings from the fact that interest is tax deductible. So what would be our after-tax cost? With Dolby's 30% tax bracket, our after-tax cost would be 5.31. And that is what we call the after-tax cost of debt. And that's what we're after. That's our component cost of debt. We want to look at our required rate of return, required rates of return on an after-tax basis. We want to consider taxes. Any questions on that before I move on? And the cone is silent. All right. The other source of funding that a lot of companies use, that our company is going to use, is retained earnings. Once again, this is not the retained earnings account on the balance sheet. This is the portion of this year's profit that the company will hang on to and therefore have in cash. So the question is, what should be the component cost of retained earnings? That is, what rate of return should we see as a minimum that we need to earn on retained earnings funds? Now, what I'm about to show you is not theory, it's practice. Companies try to get in the heads of the shareholders to figure out what the shareholders are expecting on their stock. Here's the logic. Retained earnings belong to the shareholders. Therefore, retained earnings are part of common equity, just like the stock shares are. If it's all part of common equity, it all has the same risk, so it ought to have the same required rate of return. Short version, management tries to figure out the rate of return stockholders are expecting on their stock in the market. And it assigns that as the component cost of retained earnings. Now, we have dealt with two models that try to get into the heads of the shareholders to figure out the rate of return they're expecting on their stock, or the return they think is reasonable. The CAPM and the dividend model. Suppose for our company, we have the following CAPM type of information. The average stock, those with betas of 1, are expecting 12%. Treasury securities, which are considered risk-free, 7%. And our company, with a beta above 1, it's above average in risk. So if we run it through the CAPM, we get a required rate of return of 14%. We believe that's what our stockholders are expecting on their stock. So if we believe the CAPM is a good model for our stockholders' expected returns, then we'd use 14% as our required rate of return on retained earnings. We'd use this as the component cost of retained earnings. Now, if on the other hand, we felt the dividend model fit our stockholders better, let's assume Ultra's stock is trading at 21 bucks. The dividend for the year just ended was $2. The forecasted growth rate in dividends is 5%. Then we would use the dividend model to solve for what we think our shareholders are expecting, to solve for the component cost of retained earnings. We did this in the last chapter. And if you recall, the dividend model is based on an algebraic time value function. So things like the growth rate has to go in decimal form. And for that matter, the answer comes out in decimal form. So if we use the CAPM, we think our stockholders are expecting 14%. If we use the dividend model, we think they're expecting 15%. Why do the two models give us different answers? They're based on different assumptions. The CAPM assumes our shareholders focus on market risk, beta. The dividend model assumes our shareholders focus on dividends and the growth rate in dividends. Since they focus on different things, it's no surprise they come up with different answers. So which model should Ultra use? Ultra should use the model it thinks best fits its shareholders. Utility companies, which are the big dividend paying companies, they tend to use the dividend model. a lot of other companies will either use the CAPM or some variation of it that you haven't seen. And by the way, let's assume, just for the moment, that, just for grins, let's assume our company uses the dividend model. Back when we found the after-tax cost of debt, we multiplied R sub D, the interest rate on debt, by 1 minus the tax rate. Why? Because interest expense is tax deductible. Should we do the same thing for the cost of equity? And the answer is no. Dividend payments to shareholders are not tax deductible. There is no tax break, no tax savings. Or another way to say it, R sub S is already in after-tax form. Sorry about all the lines there. Think of it this way. If a company wants to pay dividends to its shareholders, is it allowed to pay it out of before tax income, or must it pay them out of after-tax income? And the answer is it must pay dividends out of after-tax income. There is no tax break with equity funding. So we don't make any adjustment to the required rate of return on equity. We don't make any adjustment for taxes. Try the following problem. See if you can arrive at the check figures. So, That was weird. Yeah. Any of you get my figures? Okay, cool. I had to go back to the, okay. Let's play with this a little bit. It's earlier, for Dolby, we found the cost of debt was, I'm gonna round it, 5.3%. And let's say Dolby uses the CAPM. Dolby feels the CAPM is a better fit for its shareholders. And let's assume that Dolby has the following capital structure. is 50% debt, 50% equity. If that's the case, what would be Dolby's WACC? If it's 50% debt, then the weight for debt would be 0.50, and the cost of debt would be, or the component cost of debt would be 5.3%. Dolby would need to earn an after-tax rate of return of 5.3% on any money it gets from selling bonds. And on the other half, the weight for equity is the other 50, and it's figured out using the CAPM. It would need to earn 16%. So Dolby would have a cost of capital of 10.65%. Now let's assume Dolby is looking at the following projects. Project proposals. Three of them, X, Y, and Z. Project X would cost 20 mil. Sorry. Boy. And have an expected rate of return of 9%. Project Y would cost 50 mil, have an expected rate of return of 13%, and Project Z would cost 80 mil and have an expected rate of return of 10%. What's your decision on Project X? How many of you think we ought to accept Project X? Is X good enough? Since our cost of capital is 10.65%, that's our hurdle rate. Remember, the cost of capital, think of it as a hurdle rate. The project's got to beat that to be good enough, to be acceptable. So what would our decision with Project X be? Since we require over 10.5, expect 9, it's not good enough. We'd reject X. What about Project Y? We require a little over 10.5. We expect 13. Y would be accepted. Then finally with Project Z, we require 10.65. We expect 10. The Z is not quite good enough, so we'd reject Z. And actually what we would end up accepting is Project Y. Questions? This is where I got with my 10 o'clock class, so this is where we will stop. I'll have the Zoom recording posted to Moodle probably by tomorrow afternoon. But I do hope you'll look at the voiced over PowerPoints. I had to break them into more files because they're, audio visual files are a lot bigger. But I'm a lot slower, more methodical, and quite frankly, my voice is better. Not a work of art, but a lot better than it is now. So you may find the voiced over PowerPoints very useful to you. Okay. Any questions before we adjourn? Anybody? Thank you all for attending. Remember, we meet Wednesday. We do not meet next Monday, but we meet Wednesday of next week. Okay, guys, be safe. Bye-bye.